Time for our ETF Spotlight. Mike Santoli on the floor with a look at the divergence we're seeing continue here with American and Chinese technology companies, Mike.
Yeah, Sarah. So we've been talking about these global divergences for a while. In general terms, the U.S. market has tremendously outperformed all non-U.S. indexes. And the tech comparison between the U.S. tech stocks and Chinese tech stocks is kind of interesting because it's apples to apples on a sector basis. Obviously, it's been pretty profound. Look at the chart of the QQQ, that's the NASDAQ 100 ETF, and the Chinese version, which is the CQQQ. Tremendous split, as you see, starting in the spring. But here's what's interesting on the right side of this chart, starting to see some bounces in the Chinese stocks as the tariff fears either used themselves up or there was some sort of sense that maybe they were easing up as the QQQ, the U.S. stocks, have backed off. So the Chinese portfolio is up about 8% from its lows. The U.S. NASDAQ 100 is down about 1.5% from its highs. So a slight closing of the gap right there. One reason this is interesting for a lot of people who trade emerging markets, the EEM, the emerging markets ETF, is very, very heavily weighted in the same exact stocks that run the Chinese tech ETF. It's Alibaba and all the rest of it. We also have a chart of Amazon against Alibaba, which shows basically these two massive e-commerce companies, very similar chart, and seeing some very tentative signs that the Chinese counterpart is maybe starting to bottom right here. Not sure they have to converge, but it probably would be better for global market stability if you didn't see these lines going in opposite directions at a steep angle for very long, guys.
All right, that's definitely on point today. Mike, thank you. Mike Santoli with our ETF Spotlight.